This is the working investor. The whole entire market went down, but I have two positions that together are actually holding its NAV. It's holding its value and it's providing high yield dividends. And actually, it went up a little bit. It's almost like these two positions are laughing at the entire NASDAQ and the S&P 500 because these are the two indices that took a little dive. So the two underlyings I'm talking about is TSLY and CRSH, which is the synthetic cover call and synthetic put ETFs on the same underlying of Tesla. And I invested $2,500 together and 12 aka $1,250 in each of these. Tesla took a nosedive because they missed in earnings, and the inverse of Tesla, which is the crash, which would, because it took a nosedive, TSLY would go down, but crash would benefit from it. But if you add up the 1,400 and change plus the 1,134 and change, would be more than $2,500. It's actually 2,535 and change. So this is phenomenal that it did not just did not lose its NAV together, because I look at them as a holistic sum of its part, 50% allocation each. So I look at them as two components of one holistic being. So I find that it helped me hedge against this market. Of course, I'm not a financial advisor, and of course, there's expense ratios that could suck out of the earnings, and of course, there's something called put skew, and there's something called call skew, and these things could also skew how much premium you get in each one. So let's do a little deep dive on these sandwiches. This is like the new term that people are talking about on YouTube, the sandwich strategy. I think it's more appropriately called the synthetic strangle strategy, because a strangle is basically when you sell a call and you sell a put. So it's like we call it a short strangle, and you make premium on both sides. Or you could do a long strangle too, but basically if you have a synthetic call and you have a synthetic put, would it not be a synthetic strangle? And the idea is to be delta neutral. And again, we don't choose the positions, but we could choose the allocations. So there's a couple criteria. So before we get to there, let's talk. It's very important to know that this high yield dividend world plethora of funds coming out every single week. These are the new kids of the block. This is the cool new hip thing. It's not the old fashioned dividends of 1% to 2% dividends, in Campbell's Soup or I don't know what, the 4% dividends. We're talking like 20, 30, 40% dividend yield, which is phenomenal as long as there's no NAV erosion. Because if you have NAV erosion of 40% and you got 40% yield, guys, you got nowhere. You've gone nowhere. You're like back to what you actually lost money because now you have to pay taxes on the dividends that you received, but you actually, if you have $1,000 and you lost $400 in value and you got $400 in premium, you're back to nowhere. You actually lost money. But another point I wanted to make is, again, so the key is if the NAV could hold out, if the net asset value does not fall. If it just holds where it is, then yes, maybe it will be worth it. Another thing to know is that there could be a solid underlying, that it's a good solid underlying in itself, but may not be a good thing to trade as an option, because not everything is so tradable as options. There are a lot of great companies out there that we all like, these blue chip companies, but they may not be good for certain option strategies. For example, if you're an option seller where you collect premium, like all these people, people are investing in these new kids of the block. They're investing in these new funds. They're option-based funds. So I think it's paramount to know what you're investing in, and it's paramount to have, I think, a good fundamental understanding of options to know what these option funds are investing in. So there's something called implied volatility. That's what I'm trying to get to. So for example, Apple and Google, I think right now they are solid companies. I'm not an advisor, but it's in most of the indexes. If you pick any, Vanguard Total Index, you'll find a big allocation of these. The S&P 500, the Nasdaq, both carry a huge amount of the Magnificent Seven, which includes Apple and Google, but they don't have as much premium, let's say, as Tesla. They don't have as much premium as NVDA. They don't have as much premium as Amazon because the implied volatility is less. The more volatile you think something would be, the more money you get paid in premium if you're a premium seller. So hence, you'll see like with the APLI or the GUI, you'll notice, and that's why I sold off on these, they don't provide much, compared to the other underlyings like AMZ or NVIDIA, they don't provide the same amount of dividends per yield compared to those. They're a fraction of it because they're not as volatile. Doesn't mean they're bad companies. They just may not be the right companies for options at this time, because at any moment there could be earnings, there could be things that happen that could cause increase in volatility, but at this moment they tend not to be. Another thing which I want to look into is cyclical or cyclicality. That's a thing. So if you look into the automotive sector, right, and Tesla is in the automotive sector, you'll notice that they're very, very, very cyclical. Let's look at Toyota Motors, for example. Let me show you an example. Let's go to max history, right? Toyota Motors. You'll see that, yes, there is and we're going back over 20 years because this goes back to like 2001, 2002. I'm sure there's more history than that, but this is just going back a couple decades. You'll see that, yes, there's ever so slight positive drift, but there's a lot of ups and downs. The demand to buy a vehicle is not the same every single day of the year. There are certain seasons where people tend to buy more vehicles, and there's certain seasons where people are not really looking into buying vehicles. I mean, I'm sure every day someone is, but I'm saying the mass majority of people. So there's quiet season and there's busy season. There's cyclical. So again, I don't know. I'm not every single intricacies of the automotive industry, but that's just, what you see. Let's look at Honda Motors, right? Honda, you could put it in whatever company you like, look at this. You go to max return, see how choppy it is. There's volatility, but there's also cyclic. It goes in cycles, up and down, up and down. There's actually not even really a positive drift. It's kind of like just floating in this range. Again, this is going back over 2 decades, right? Let's go to Ford, and we'll stop over there. So you go to Ford Motors, right? Look at this. I've been trading Ford for a while. I mean, back over 5-6 years ago, and they're kind of where they are. They're like $12 a share, $10 a share. They're not moving much. They're just cyclical. But again, look at Tesla. Tesla had a crazy spike. Again, past performance is not indicative of future gains, but in general, I would imagine because it's part of the automotive sector, it also would be sort of cyclical. I guess, of course, it spiked. I had this crazy spike, but in the past 5 years, even though it is up significant, but if you look a little closer in the past 3 years, it's kind of staying in this range. It still didn't even hit. It's not even back to a peak where it was. Of course, it missed earnings recently as well, but that's why I like volatile cyclical companies, because this way, I'm not the biggest personal fan of the Tesla company. I like, but I'm a fan of money, and I'm a fan of volatility, and I'm a fan of staying delta neutral, and I'm a fan of, making money on Tesla and the inverse of Tesla, and keeping my NAV. Again, past performance is not indicative of future gains. Who knows what will happen? But I'm looking into right now the NVIDIA. I mean, all we have is 3 options: Tesla, NVIDIA, and CONY, which is Coinbase and Fiat. But I'm looking more into Coinbase and Fiat because, of course, there's something called the crypto winter, as the crypto traders know. And there are times where crypto is hot, and there are times where crypto is not. And that seems like it's very cyclical, but it does seem to have a bit of a more of a positive upward drift. But again, it's very, very mostly heavy on the cyclicality. And I would imagine Coinbase, is affected very much by Bitcoin price, and Bitcoin price affects other crypto assets. So it's all one holistic system, seems like. So basically, it seems like they're cyclical and volatile. And yeah, so right now I'm looking into that. I do have NVDA. I'm right now I'm happy just holding NVDA. Because I feel like, yes, it's super volatile, but I don't know if it's as cyclical as the others aforementioned. It seems like it's goes like with most tech, it's just very positive, drifty, and less cyclical. Which different underlyings are better for different strategies. This is just my 2 cents. Again, this is for informational purposes only. I hope you guys enjoy. Have a wonderful weekend. This is the Working Investor over and out.